And I am what is called a qualified intermediary for 1031 exchanges. And right there is probably a whole lot of foreign jargon that nobody knows about. But basically, what I do is I'm the person that helps investors sell investment real estate and use a process to then buy investment real estate and not have to pay tax on the profits from their sale. Instead, you get to use those profits for your own investing.
You're listening to the Rich State of Mind Show, the podcast made to make you the total package in the entrepreneurial world and give you what we call a rich state of mind. If you are here looking to learn about real estate investing, marketing, elevating your business, and developing your mindset to get to the next level, then you are at the right place. Stay tuned and be sure to join our community on richstateofmind.com. Now here's your host, Anthony Ritchie.
Hey everybody, what's up? Episode of Rich State of Mind, where I'm talking to Dave Foster. He's the founder and CEO of the 1031 Investor. He's a decreed accountant and a serial real estate investor who is a qualified intermediary and consultant for tax saver strategies such as the 1031 exchange and the Section 121 homestead exemption. Those are two things that you should really look into. And obviously, you'll hear more information about it in this episode. He started off as a fix and flipper, but he realized that 40% of his profits was going towards the IRS. He didn't like that. So that's where he kind of got into the 1031 exchange. So Dave breaks down exactly how to use a 1031 exchange in layman's terms. He explains to us how he moved away from Denver, Colorado to Tampa, Florida for over 10 years using the 121 homestead exemption so that him and his family could move onto a boat, actually. So please check out the episode. I think it's great. I personally used the 1031 exchange and I have loved the way that I was able to use it and apply it and been able to make some pretty good profits on the way I used it as well. So please check it out. Thank you for listening.
Hey, Dave, thanks for taking the time this evening. We're going to talk about 1031 exchanges. Long time coming for this episode to even come up. So I'm glad we're talking about it. It is an awesome tool to have in your real estate investing career. So if you could please just tell us a little bit about yourself and what you do.
Anthony, it is so good to be here. You had me at the name of your podcast. How could I not come on a show that's named after a song by one of my favorite composers, Billy Joel? And I think you're actually from New York State of Mind, or Rich State of Mind. I love it. My name is Dave Foster for the folks that are just tuning in. And I am what is called a qualified intermediary for 1031 exchanges. And right there is probably a whole lot of foreign jargon that nobody knows about. But basically what I do is I'm the person that helps investors sell investment real estate and use a process to then buy investment real estate and not have to pay tax on the profits from their sale. Instead, you get to use those profits for your own investing. That's what I do.
And so why would somebody want to do that? Why would they want to sell their home and 1031 it? Is it to just buy a property that is the same value? Why would they want to do something like that?
Yeah, that's a great question. So from a pure real estate point of mind, the 1031 is really good when you want to do one of several things. Either you have a property that has a lot of profit and you're wanting to move it into something else. Let's say you started investing in California and appreciation rose dramatically. And now it's kind of stalling out, but you want to go to someplace where you're going to get better cash flow. So you sell in California, do a 1031 exchange, and go buy duplexes in Omaha. You can use the 1031 exchange to do that. Another example is moving classes of real estate. Many people start out as single-family investors. As a matter of fact, the most common investor we've got is what I call the accidental investor. Two people who get married, but because we're getting married later in life, each one of us owns a house. So we're going to move into one of them. By the way, you know which one you always move into, Anthony?
The wives.
Exactly, because it's the only one that's clean. So you move into one of them, the other one becomes a rental. And boom, you're a real estate investor. A few years go along and you think, that's kind of cool. I'm liking that cash flow. So you sell, but now you're thinking maybe it's time to start to grow. So you can use the 1031 to sell a one property and purchase several. So you can start to grow your portfolio. You can also do the opposite, which is you can sell several properties and use the proceeds to go buy maybe a commercial building if your end goal is to get into multifamily or large scale commercial. Or let's say that you've owned your property for a long time. There's this concept called depreciation, which is basically just a pretend shell game from the IRS, where the government lets you pretend that your property loses value every year. So you get a tax write off. But if you ever sell that property, guess what? The IRS makes you pay it back. So if you do a 1031 exchange, you don't have to pay that back. And if you buy more property than you sold, you get additional tax write-offs. So just from a logistical point of view, if you've got a property maybe that has a lot of capital expense items coming up, maybe the roof solder or the HVAC, you can do the 1031 to go buy new construction where you're not worried about any expenses coming up. So changing classes of properties, changing locations of properties, changing from fewer to many, from many to fewer, the 1031 can accommodate all of that and let you keep the tax working for you. And that's probably the biggest why, is because you get to keep the tax working for your benefit.
Why does it exist? This I've learned when it comes to tax incentives. I know people will say tax loopholes, but I like to call them incentives because the government will tell us, hey, we want this to happen and we will incentivize it for you. Why would the government want to incentivize something like this?
Oh, yeah, that is one of the most profound statements that I've ever heard, Anthony. That's exactly correct. A mentor of mine challenged me with this. Oh, it was actually just in the last few months, where he said, Dave, stop thinking about the tax code as a way for the IRS to raise money. I mean, they do because they want to build roads and that kind of stuff. But the reason the tax code exists is to do exactly what you said, incentivize behavior. And if you perform the behavior that they want, you are incentivized with tax savings. So you're exactly right. 1031 is one of the original parts of the tax code. Came into being in like 1920.
Okay.
So what was happening at that time in America? We were becoming a much more concentrated agricultural economy, and we're right on the cusp of moving into the industrial age. So there was a lot of consolidation going on in the agricultural sector. Families were wanting to grow farms from the small family plot and start to buy bigger farms and treat it more like a business. Well, the problem was that if they sold their small farm and wanted to go buy a bigger farm, most of the time they didn't have the cash from the sale to be able to pay the tax and still go buy a new property. So they were stuck. Well, in order to encourage the growth of our agricultural sector, the IRS started 1031 exchanges. So as long as you are buying more real estate or buying bigger farms, you got to use the tax to do that. And that was their incentive. And now today, after 100 some years and a couple major court cases, it's available for everybody, whether you're selling a large farm or a small single family rental. The 1031 lets you sell it and go buy new real estate and use the tax for your benefit.
And what are some of the requirements? I would assume that the requirements have changed over the last 100 years and after a couple of court cases, but what are some things that have to be identified for you to be approved to do that?
Yeah, that's kind of the deep weeds, of course, right? because the IRS, when they lost the Starker versus Commissioner case, and it was finally settled in 1996, they had to let everybody do 1031s, but that didn't mean they had to like it. So out of that, we've got a pretty rigid set of requirements. It's only available for investment real estate. You have to sell real estate and buy real estate. There's a couple timing issues. You only have 45 days to identify your potential replacements, and you have a total of 180 days to complete your purchase. So the timeframes are kind of constrained. Like I mentioned earlier in the podcast, you have to use the services of an unrelated third party called the qualified intermediary. That's the only role that we can fill, and nobody else who has a business or family relationship with you can fill that role, because the IRS does not let you have actual or constructive receipt of the proceeds. They have to be held apart from you in order to do it. The taxpayer that sells the property has to be the same taxpayer who buys the property. So if you sell a property you own personally, you have to buy a property that you're going to own personally. So you have to match up the taxpayer because it has to appear on the same tax return.
Yes.
Both the old property and the new property. And then lastly, the investment requirements. And this is probably the most misunderstood, because what the IRS is willing to do is leave their tax with you, but they're expecting you to leave both the profit and your original equity in the game. So in order to ensure that, what they say is that if you want to defer all tax, you must do two things. First, purchase at least as much as your net sale. So let's say we sold a property for $320,000, and there was $20,000 of closing costs and commissions. Your net sale, $300,000. That's how much you have to purchase to defer all tax. Secondly, you have to use all of the cash proceeds. Now, let's say there was a $100,000 loan. Your cash proceeds are $200,000. So you would have to purchase $300,000 of real estate using all $200,000 in cash to do that, if you want to defer all tax. Now, you and I were just talking about a situation where it's okay to take cash out. It's okay to buy less than you sold. Why do people like to do that? Sometimes they're trying to reduce their debt exposure.
Yep.
Or they've got some other type of debt. Maybe they've got a car that's at 12% and they want to pay that off so they can get out from under that. You can do that, but you'll pay tax on the difference. So that's a nice way to kind of juggle things to give yourself the best benefit. But those are the 6 basic requirements. And we managed to state them in about 2 minutes, but there's about 10,000 pages of case law, and you need that QI to be your guide because it's a little bit messier than it seems sometimes.
No, yeah, you're right. And so when I did my 1031, Ute is her name. She breaks it down so well, by the way. I love how knowledgeable she's been and been very at first hand walked me through everything until I kind of got the hang of it, but kept putting it in escrow, couldn't see my money at all in order to buy my next property. I only identified one because the one that I liked was 40 grand under the market value. So I was like, this is it. I'm not going to, but you could identify, I think they gave me up to about 3 to identify.
Yeah, there's the identification list is another quirky little thing. You can identify up to 3, and it doesn't matter how much they're worth. So you sell a property for $300,000, you can name 3 $5 million replacements. So if you're trying to buy bigger than you sold, you want to make sure and keep your list to 3 or fewer. You can name more than 3, but if you do, then the total value of the list can't be more than 200% of what you sold. So that's really good if you're trying to sell a $300,000 property and buy like 4 really small properties.
Yes.
That kind of thing. So,
yeah, because they gave me that as an option. The property I was buying was actually cheaper than what I sold, only because I'm renovating. I did a 15% down conventional loan, renovation conventional loan. So the house after it's renovated will be worth more than what I sold. But so I had the option to boot the rest of that money. And they said, hey, you can use the rest of that money. I think I had like another 20 grand. You can use that 20 grand left over and buy another spot if you would like. And I said, no, I'm gonna keep it because yes, I was trying to pay off some debt and then I was gonna boot the rest. So yeah, it worked out that way. I liked it. I'll do it again, actually. And so we talked about requirements. We talked about how the basics, how it works for your taxes, and how you can increase your portfolio. What are some common mistakes or issues that you see people have when it comes to the 1031?
Great question. Probably the two most common mistakes I see. Number one, we are in an incredible seller's market, right? Stuff's flying off the market left and right. The only 1031s that I still see failing, though, we do internal audits all the time. And among our clients, over 90% of our clients are still able to sell their old properties and find new properties they like to complete their 1031. So it's more a perceptual barrier than it is reality. But the 1031s that I do see fail are those where people are not laser focused on exactly what they want and where they want it. You can't be looking nationwide trying to decide between vacation rentals and duplexes and hope to do a 1031. It's not going to happen. You got to zero in on an area. You know, where you guys are in Virginia, you know that market like the back of your hand. So when a deal pops up, you know it immediately. If you're trying to rely on too many people nationwide, you're going to get paralysis by analysis and your 1031 is going to fail. Now, that's not the worst thing in the world because there's no penalty for starting a 1031 and not completing it. It's simply your accountant simply reports it as if it didn't happen. And you pay the tax when you would, the same amount that you would. So it's one of those things where you don't have to be scared that you're going to end up paying a lot more money. But if that's the case, why wouldn't you take a shot at it? And like given our numbers, for us, say a normal garden variety exchange costs you a little less than $1,000. So if I were to tell you, Anthony, I got a bunch of lottery tickets I'm going to sell you, and you've got a $50,000 tax hit that you're going to have to pay if you don't do the 1031. So I'm going to sell you these lottery tickets they're going to cost you $1,000 each, but every one of them has a 90% chance of winning $50,000. How many of those tickets would you buy?
All of them.
Absolutely. That's what you can do with the 1031. There's basically no risk in trying it. And if it works, great. And if it doesn't, don't ever forget, nobody ever went broke paying tax on profits.
No, you're right about that. I mean, I love this this method. I think it needs to be definitely talked about a bit more. I love also how it encourages growth. Right, you're doing it because you're looking to expand, you're looking to elevate in some way, and that was how I looked at it too. I did it for cash flow, to increase my cash flow. And so we talked about we haven't talked about yet is the advanced 1031 exchanges. So we have a reverse 1031, which I've heard about like one time, and then I don't know if I'm saying this right. FIRPTA, FIRPTA.
Right.
And construction. So yeah, let's start with reverse.
Okay.
Well, what is that?
Well, the reverse exchange kind of encompasses a whole wide variety of things, including construction exchanges and improvement exchanges. So they're all kind of the same animal. And they are based off of the statutory requirement that to do a 1031 exchange, you have to close your sale before you can take title to your new property. So the 1031 by statute is a sale followed by a purchase. But what happens if I found my new property first? I found the one I've got to get. I love this property, but I haven't sold my old property yet. This is where the reverse exchange comes in. Under IRS statute, what we can do is we form a holding entity. It's called the exchange accommodating title holder. Fancy name for an entity that you don't own. And we take title to the new property. And then we can hold that for 180 days until you've sold your old property. And so all you do is you sell your old property, and what do you buy? You buy that property from the entity that's been holding it for you. You don't actually purchase your new property first because you can't legally, but you control it. And that's the reverse exchange, is it makes it look like you sell, you buy first, and then you sell. And that can be an advantage, like in today's markets where you're scared. The toughest thing you've got to do is find your new property. So you want to try to take care of that job first. And that's where the reverse exchange can really work for you. Now, let's take that another step further. What if the property you want to buy doesn't exist yet?
Okay.
You're looking maybe in Myrtle Beach and there's some new constructions going up and you want to buy one of those, but it's not going to be done for a while. So you would do what's called a construction exchange. We would take title to the lot, and then the builder starts building on the property. Once that's done, you complete the sale of your old property, and then you take title to the new construction, because the law doesn't let you exchange into improvements on property you already own. So if you buy the lot using a 1031, you're done. You can't exchange into the improvements after that.
Yes.
But if we take title to the lot, you can then make the improvements on it. Now, the problem with construction exchanges in this state is they're almost impossible because we can only hold the lot for 180 days and nobody's getting construction done in that amount of time. So it's nice in thought, very hard to execute, but an improvement exchange is perfect. Let's use yours as an example. What did you sell your old property for?
Sold it for 171 and I got 54 grand in profit.
Okay. And then how much did you pay for the new property?
I needed to put 36 down, and that was 15% down between the purchase price and what the renovations were going to be.
And what was the actual purchase price?
So 150. So the actual mortgage, the actual loan, or in total?
The actual purchase price of the new property?
Oh, 129.
When you bought it.
129.
129. There we go.
Yeah.
So basically we had that $40,000 boot, right?
Mm-hmm.
What could have happened is that we would have taken title to the new property. So instead of you purchasing it and having to take $40,000 in boot, we take title to the property at 129, and then you put, while we're holding it, $40,000 of improvements into it. Now, what's that property worth?
195.
Well, if we put 40 into it plus 129, it's worth 171, right?
Oh, yeah. I'm thinking about after it gets appraised in that area.
Right. Yeah.
Like
We
that.
can't go on the appraisal. We got to go on the actual purchase numbers. But see, at that point in time, you would have completed the sale of your old property for 171, and you would have bought your new property for 171. The original purchase price of 129 plus the improvements. So you would have avoided all of the boot in the exchange by doing it that way. That's what an improvement exchange can do. And now the rest of that story is exactly what you said. The thing is, it's really not worth 171. It's worth 191, isn't it?
Yes, around that 190, 193.
So at any point in time, you did this reverse exchange. You managed to sell your old property, defer all the tax, get a new property that already has equity in it. And at any time you want, once you take title to that, you can do a cash out refinance.
Yes.
pull the cash out to go buy more real estate, pay off that bill that you wanted to pay off, whatever it is you want to do. But when you do the cash out refinance, after the 1031, it's not a taxable event.
So what do you need from me for you to feel, secure in doing this, a holding title for me for 6 months? What am I showing you?
Well, you're providing the money. So you're, in essence, the technical way to do it is you lend the money to the entity. The entity gives you a mortgage. So we own the property, but we owe you the money. So guess what? You're not going anywhere.
Yeah, I'm not.
Lease
Yeah.
the property to you for exactly the same amount as our mortgage from you or to you. So basically, all the money just washes, and you've got total control, total use, but no ownership.
If I knew that, I would have did something a little different last year. If I knew to do that.
There's always next time, Anthony.
Yeah, there is.
So
Okay.
yeah, so those could be a great opportunity. Reverse exchanges. Now, the thing you have to realize is that they're fairly pricey, and they've got some time constraints as well. But especially for improvement exchanges, they can be awesome in helping you do value adds. We do a ton of these for multifamily projects where they're buying these things for maybe $1 million and they're going to put 200,000 or 300,000 into it. But when they're finally done, it's going to be worth $2 million. And so they sell their $1.3 million property, use the proceeds to go get the to give to the entity. We take title, they do the improvements, boom, they own a $2 million property and didn't pay a penny in tax.
I love that, especially because now I'm not rushing. I've already identified my property, because this happens where we come across something, but the timing's off. Because I've had one of the guys I interviewed, he was putting out ads like, hey, I'm looking for a property to buy now before my 45-day ends. Please give me something. I won't even take as sweet as a deal as I usually would, just so I don't have to pay taxes on this, 80 grand or whatever. But I like this idea. I wonder if he even knew that was an option for himself.
I don't know. But what he does illustrate, though, there is this thing, and we're going to get back to FERPTA because I know people are still thinking about that, but there's this thing that I call the poison pill of 1031 investing. You have to have realistic expectations.
Okay.
And so when you're looking for your replacement properties, you cannot think and look and expect that you're going to get a property that's the same deal as the one you're selling, because you bought that property 3 years ago. You're not going to get the same deal.
Yeah, you're right.
You're going to, in your mind and my mind, you're going to vastly overpay. Does that really mean you're overpaying? No. It means you're paying what is the market rate. Or maybe you're finding a bargain. Great. But don't forget, when you sold your property, you didn't sell it for 3 years ago either. So you got the benefit of the bump on your sale. Don't feel bad if you don't get the same bargain on the back end.
Yes. Yeah, you're
so
right.
The best time to start a 1031 in a seller's market is the worst time to try and finish it of a seller's market. It's just how it is. But the reverse is also true. The worst time to start a 1031 is a buyer's market. It's hard to sell. But that's also the best time to finish because there's so many more properties to buy. So you just kind of have to say, okay, the 1031 is what it is, and it exists in this market. So I'm going to keep my expectations realistic. And if I'm going to sell, I want to make sure I know why I'm selling, because that's the motivator. Because you're not going to sell and find the same bargains, but you can sure sell to change categories, to go like you did from appreciation to cash flow, to change locations, to get into a different type of reset. All those kinds of things are really the primary motivators for the 1031.
This is great. I'm really hoping people get a lot of information or taking notes on this, because now you have me thinking about my plan for not 2022. 2022 has kind of been already cemented, but 2023 at least. I gotta wait for some appreciation. And I like the fact that you brought up about, hey, your money's not gonna be the same from 3 years ago, because I was frustrated because I was like, my 50 grand is not stretched like it did 3 years ago. Like I was so annoyed.
Yep. It's so true. Well, and when you're an investor, you're trained, right? It's just in our blood. We have to find a good deal. But what is a good deal today is different than what a good deal was 3 years ago. And the good investors realize that and make accommodations. You know what? Can I address FERPTA real quick? Because I want to talk about the
Let's talk
four
about
Ds
that.
of investing, because this is going to segue right into it. So FERPTA stands for Foreign Investment in Real Property Tax Act. And it's basically a withholding for any foreign seller who sells a property in the United States. 15% of the sales price of the property has to go into a withholding. They don't get it back. They don't get to use it in another purchase. It just goes, and they have to file a tax return in order to get it back. So it's really a nasty gotcha from the IRS for our foreign sellers. But the thing is, there are a couple ways where the foreign seller can use a 1031 and the FERPTA does not have to be withheld. It's as simple as that. It involves some details in the process, but it's for anybody who is a non-US taxpayer who wants to sell a property and not have the withholding withheld.
Okay, great. And I definitely make sure I'm gonna probably write a blog on this, and because this is definitely deep stuff.
Yeah, exactly. But when you were talking, this is what's going to be fun. I love to live in the strategy world, as you can tell.
Yeah,
The
right.
nuts and bolts, okay. Yeah, we can talk about that. But let's get fun. Let's talk about next year for you. Let's talk about 5 years from now for you. Let's talk about 20 years from now. You know, we all have to start with the end in mind.
Yes.
That's what Stephen Covey said. So you have to start thinking about your exit strategy years and decades before you even start. So with this, I have this thing I call the 4 Ds of 1031 investing. And so for everybody taking notes, are everybody ready? D number 1, defer. When you buy a property and you're using it to generate income, it doesn't matter what it's worth. You will never have to pay tax as long as you don't sell. So everybody says 2008, the dark days, right? It was horrible. All of my 1031 investors who did not have to sell property did not lose a penny. And they're worth multiple upon multiples of millions. Because in 2008, they lost 80% of the value on their real estate, but only on paper. Rents were the same. And here we are, 2022, they got tons of money. So don't sell a piece of property. You will never have to pay the tax. Second D, defer. Because anytime you sell a piece of real estate and do a 1031 exchange, you will continue to indefinitely defer all of the payment on the tax. So if you want to sell an appreciation state and buy cash flow, you'll defer. If you want to sell single family and buy multifamily, you can defer. And remember the impact of that. If I sheltered 50,000 in taxes, I'm making the income off that 50,000.
Yep.
And if you can make 10% on your portfolio, that's $5,000 a year that goes into your pocket instead of to the federal government. And I don't know about you, but $5,000 a year, that's real money to me.
Yeah, it is.
I take that pretty seriously. So as long as anytime you sell, you do a 1031, you'll continue to defer. You know what D number 3 is?
Defer.
Exactly. Because anytime you decide to start to slow things down, and this is what I call the life cycle of a real estate investor. When we're young, we're energetic, we want to grow. But at some point in time, we want to start to slow down. So we start to do things like consolidate. selling several properties to go buy a large multifamily
Yes.
that we can have managed, or to move into some forms of passive investing, like Delaware statutory trusts, certain types of syndications, or maybe we start to think about lifestyle and we do some 1031s to sell rental properties to go buy vacation rentals where we get some use ourselves. Or let me throw some octane on this fire here. The 1031 requires that you sell property that you've held for investment and you buy property you intend to hold for investment. But you don't have to hold it for investment forever.
Okay.
You're getting close to retirement. Go buy that vacation rental in Panama City using a 1031 exchange. In a couple of years, when you're ready to retire, kick the renters out and move into it. As long as you don't sell the property, the third D is you continue to defer. And what are you going to do with the house you moved out of? Well, Section 121 deals with your primary residence. And if you sell a property you've lived in for 2 out of the 5 years prior to sale, as a married couple, you get to take the first $500,000 in profit tax-free. So you want to slow down a little bit, move into your vacation rental, no tax, sell your old house in Cincinnati, take the $500,000 in profit tax-free, and use that to start your retirement.
I will be replaying this several times to make sure that I get this right, because I am already thinking about retirement. I was just telling you about how my wife is retiring soon, and I soon after, well, not too soon, but enough to get something to start putting up a plan. Because like you said, you need to have the end in sight. And you are definitely having my brain thinking about those things. And I hope for those who are listening, you're also kind of thinking like, how can I situate my portfolio and my personal life to where this can work out? Where can people find you? Because I want to make sure people get in contact with you and obviously bring some, business and inquiries to you.
Yeah, best way to find us is at the1031investor.com. And on there, we've got, I think, a YouTube channel of 32 videos. I've got a bunch of calculators, articles we've written, access to us, overviews of the 1031 process. Because, just like we've been saying, it's all about the planning and the strategy. We can help you do your 1031s, but we want to make sure you're the best prepared kid on the block when we're going to do them. So that's the best way to catch us there, is at the1031investor.com.
Thank you. And like I always like to ask everybody that's up here, what is your rich state of mind? What is your big why? You're such a strategist. You're definitely excited when you talk about this topic. I love talking about stuff like this, but why do you love doing this? What's your big why?
It's my big why of why I do this is because I saw what it did for my family. In 1996, when the law came into place, we saw the opportunity to use it for ourselves. And over the course of 10 years, we moved a portfolio of investment properties from Denver to Connecticut to Florida and bought a 53-foot sailboat without ever paying a penny in capital gains tax. And we moved onto the sailboat and we raised our children for 10 years.
Oh, wow.
That's the power of the
Nice.
1031 exchange. And it goes even deeper than that because, Anthony, I can't let you leave without giving you the fourth D.
Okay. Oh, yeah.
You know what it is?
What's up? What is
It's
it?
die. Because all of this deferred tax, when you pass away, your heirs get your real estate at what is called a step up in basis.
Mm-hmm.
So all that tax disappears and they get it tax-free. So you can, in essence, make the money on the unpaid tax for your entire life and then give those properties to your children, and the tax disappears and nobody ever pays it. And your kids just got the most incredible legacy wealth building gift they could ever get.
For free.
for free.
And that is beautiful when you put it like that. Yeah, this is gonna be pretty cool. I can't wait for this episode to post. Thank you so much. You really your passion and your knowledge in this. I would consider you a master. Your mastery in this craft is definitely well appreciated. This has been pretty cool. Man. Thank you.
Careful, my friend. That's just a euphemism for old.
What we say? Maybe doing something for 10 years makes you a master. So
That's what they say, right? 10,000 hours.
Yeah,
And
yeah.
I've been at this now for what, 23, 24 years. So
25,000.
yeah, I love to
hours.
work with people.
Yeah, well, it's been great, Dave. I really appreciate you being up here. Can't wait for, like I said, can't wait for this to publish. I definitely will put all your information, in the show notes, because I definitely want people to reach out to you and to get more information, and obviously your business as well. I'm not the expert. I just apply it, but I still ask a lot of questions, but I go to people like you to usually to figure out, because I'm a strategist as well. Hey, is this legal? Can I do this? I always try to push the button and ask and look for the yes in some way, and so quirky way we're doing it. So I like the fact that you encourage that, and we're going to figure it out some way, or if it is legal or not. And maybe you can't do that, but you can use the reverse one instead. You provide options, and I like that. I don't like to just be told a no, like no, but we could do this, and that's what you do. So that's why I encourage people to come find you, because you may just have to tell them to go a different direction that still works out for them, and I like that.
There's almost always a way. Just takes a few more turns.
I love it. Thank you so much. I've enjoyed you.
Thank you.
Thank you for sticking with us from the start of the episode. Please share our show with friends and family, visit our YouTube channel, and view more of our content on richstateofmind.com. See you next week on the Rich State of Mind Show.